Hello, everyone, and welcome to our third installment of our Post-SPAC series. My name is Sarah Morgan. I'm a partner in the M&A and Capital Markets Group here at V&E. And with me is my partner, Ramey Lane, who is one of our foremost experts on SPACs. And today's topics are going to cover a litany of items that are applicable to former SPACs, starting with the aptly named special place in hell for former SPACs, or the special rules that the SEC has. And then some other, now that you're public, issues facing IPO and de-SPAC companies, prior guidance, financing options, warrant overhangs, and last but not least, liquidity options and delegending requests, everyone's favorite topics. Okay, I'm going to hand it over to Ramey for our first topic here.
All right. So as Sarah said, we're going to talk about what we've titled the special place in hell. So these are the regs that the SEC has that apply to former shell companies. SPACs, while they are SPACs, have a really harsh set of restrictions applicable to them, a lot of restrictions on what they can do, and the SEC's proposed new rules that would apply to them, sort of as SPACs. For former SPACs, what we'll talk about, there's some annoyances, maybe is a better way to put it. It's, a special place in hell is probably a little bit overstated unless you just view being public and complying with general public company regs as hell, which I think maybe some people do. But as we'll discuss, these shell company rules and former shell company rules have been around for 15 plus years. And over that time, most shell companies have been SPACs, have been exchange-listed SPACs. But as we'll discuss, this really isn't a SPAC taint, it's a shell company taint. And the motivations that the SEC had when they adopted these rules were really more focused on OTC-listed shell companies, not the exchange-listed companies that we've seen over the past decade and a half. Much of what we'll talk about is really sort of just a flashback. It's a lot of the restrictions on former SPACs really are just taking the law as it applies in the regs as they applied in 2004 and not allowing former SPACs to have the same flexibility that the SEC adopted starting in 2005 for public companies. Can I have the next slide, please? Okay, so SPACs are shell companies under SEC definitions. The SEC definitions are a little odd in that SPACs are not blank check companies, which a lot of people sort of colloquially refer to SPACs as, but for SEC definitional purposes, SPACs are not blank check companies because they don't issue penny stock, and they're not also business combination related shell companies, which are carved out of a lot of the restrictions on SPACs and former SPACs. SEC first adopted rules applicable to shell companies and former shell companies in 2005, and then again in 2007. We'll talk about those rules a little bit. But the big changes were they adopted a new timeline for Form 8K for a de-SPAC. They put a little sort of timeout clause on use of Form S-8 by former shell companies. Then when they adopted securities reform, which sort of like revolutionized how offerings got done, they basically said, oh, but not for SPACs, not for former shell companies. You can't use all these new fancy bells and whistles, at least not for a period after your de-SPAC. And then in 2007, the SEC sort of rationalized and liberalized the use of Rule 144 and changed how 145 worked, which we'll talk about in a minute. But again, basically said, we've said before shell companies are bad, so while we're making these changes and liberalizing things for public companies, not for shell companies. So we're going to carve you guys out. There is one thing that they did that wasn't just you can't use the new bells and whistles. It was in relation to 144, they added a new restriction applicable to former shell companies, which is one of the bigger annoyances, and we'll talk about a little later. In March of this year, the SEC proposed rules that would be applicable to SPACs. So SPAC-focused rules, not shell company broadly rules like they had adopted in 05 and 07. The specific proposed rules that they proposed wouldn't really impact former SPACs. Most of what they've proposed, the important ones, really relate to the de-SPAC process itself and liability regime applicable to various participants in that de-SPAC process. So it really isn't focused on former SPACs at all, although if the rules were adopted, there might be some fun retroactive changes, like, all of a sudden all the banks who participated in our de-SPAC in 2021 are now technically defined as underwriters. What does that mean? How does that work? What will that do to impact potential litigation, et cetera? The way the SEC rulemaking works is they propose a specific set of rules that you can comment on, and then they ask a whole bunch of questions, like, should we do something else instead? Should we adopt this? Should we adopt that? So in the proposing release for the SPAC rules, they asked 180 questions. And one of those questions was, should we align the regulatory treatment applicable to companies that go public via a de-SPAC with those that are applicable to companies that go public via a regular way IPO? So they didn't propose that as a rule, but they said, should we do that? And B&E and a bunch of other law firms basically jumped on that and said, of course you should. Basically, Gensler has said, Gary Gensler, the chair, has said, this is just an IPO of the target company. And then the natural sort of response to that is, okay, well, then why do we have all of these shell company rules that apply if this was just an IPO by a different sort of route? They also asked whether they should apply some of the rules applicable to blank check companies under 419 to SPACs while they're SPACs. But for purposes of the audience, if you're in charge of a company that went public via a SPAC, the Rule 419 changes wouldn't impact you going forward. So the takeaway on the proposed rules is none of the proposed rules that they've adopted would make it worse for former SPACs, other than this weird, potential retroactive, sort of annoyance. What does it mean if those rules applied retroactively back to something we did 2 years ago? So maybe the SEC makes things better for former SPACs if they sort of follow through on the question, should we align it with a former IPO treatment? But it's doubtful that the rules will get worse for former SPACs. Okay, so wanted to put the rules, the existing shell company rules, in a little bit of context. Now, caution on this. I pulled this data from Professor Ritter, who writes about how one goes public. Oh, and the first poll question just came up. So if you're in here for CLE, please pick one of those. So Ritter studies IPOs, registered directs, and SPACs, and has this handy little sort of listing of IPOs and SPAC IPOs and operating company IPOs by year. Now, you got to be careful with stuff, particularly back in the 90s. It's really hard to sort of be confident about these because it was before Edgar was, mandatory filings. And there's a lot of other data out there that conflicts with this. So Ritter shows 27 SPAC IPOs in the 90s. Early Bird Capital claims that there were only 13, and they were in 1993 and 1994. So all kinds of sort of conflicting data, particularly when you are going back all the way to the 90s. But I think you can consider this directionally. So what is the context here? You can just barely see any red bars back before 2004, meaning that there were a handful of SPACs, as Ritter has defined them, in the 90s and early 2000s, but they really weren't a big thing. So the set of rules that the SEC adopted, particularly the 8K, S8, and securities reform, those were adopted in mid-July of 2005, proposed in 2004. They really predate the SPAC boom. They aren't focused on SPACs, they're focused on shell companies. And the first exchange-listed SPAC actually went public in 2005 after the 2005 rules went effective. So all that is to say, all of these rules are really, there are annoyances you have to deal with, but they weren't really focused on SPAC. They were focused on shell companies, and shell companies were viewed as sort of this abusive vehicle. Lots of the proposing releases would give examples of basically pump and dump schemes where a shell company would merge with an operating company, and then you'd have these nefarious promoters who would say, this is the best thing since sliced bread. They would push a bunch of shares out to their friends, family, acquaintances, et cetera, sometimes misusing S8 to do so. And then by the time the new operating company files an 8K saying, this is who we are, here are our financial statements, the pump and dump scheme would have already been effectuated. So basically that was the sort of the abuse that was attempted to be combated with the next rules. One of the first things the SEC did was to say, okay, this lag between closing of a transaction that causes a shell company to cease to be a shell company and actual sort of public disclosure about the target company is the problem. Because the Form 8K will let you have 2.5 months from closing of an M&A transaction to actual filing of financial statements to the target. So under this pump and dump sort of scenario that they were trying to address, they basically said, okay, we're going to cut that way down. If you cease to be a shell company, you have to file a Super 8K with all the information that would have gone in an Exchange Act Form 10. So it's kind of all the information you need if you go public under the Exchange Act. And you have to do that within 4 days of closing with no extension to file financial statements like you would have if it was an operating company buying a business. Now, this doesn't really matter so much for former shell companies. I mean, I think there's 2 that closed deals in the last 4 business days. So for the bulk of our audience, if you're in charge of a former SPAC, you've already done this. But it's important to remember that the filing of an 8K and the filing of Form 10 information keys a lot of restrictions that will eventually fall away. So knowing the date that you did that, knowing the date you filed the Super 8K, knowing the date you filed Form 10 information, which could be different. Your Form 10 information could be in an S4 or in an F4 and predate the Super 8K. But knowing those dates is important because you'll know then, okay, when can we start being a WIXI? When can we start using FWPs? When can we start relying on 144? So, okay, that's the 8K. The 144 and 145 changes, which were adopted in 2007, are some of the more important ones when it comes to considering liquidity options for stockholders post-SPAC, which we'll talk about a little later. But basically what the SEC did in 2007 was say, we're going to let selling stockholders rely on 144, the safe harbor from underwriting status, as early as 6 months after they acquired the shares and 90 days after a company goes public. So if you acquired pre-IPO and you hold for 90 days post-IPO, you can rely on Rule 144. The SEC said, no, we're not going to let SPACs, former shell companies, do that. You have to hold a full year from ceasing to be a shell company, and the company has to be current on periodic reports, so 10Ks and 10Qs, indefinitely. That current reporting requirement for regular way companies falls away after 1 year of holding the shares, which is, we'll talk about a little bit when we get to the delegending point. The other thing that the SEC did is it basically reversed something in Rule 145 called the presumptive underwriter rule, which was if a company goes public via a merger, business combination, share, etc., everyone who was an affiliate of the operating company at the time it approved the merger, et cetera, is a deemed underwriter, which means their shares need to be registered for resale, or they can comply on 144 if they hold it long enough. And the SEC got rid of that, except it said, oh, but if you're a shell company or a former shell company, that rule applies. So that effectively requires registration or compliance with 144 for affiliates of the target company at the time of the de-SPAC.
And I think I guess one point to make here.
Go ahead.
This puts a lot of pressure on on getting your resale shelf up for those people that hold restricted securities, because for a year, I mean, practically speaking, they're not going to really have any other liquidity options but besides selling off of that shelf and keeping it current. Right.
Yeah, and one of the questions on this goes to the point I made earlier that your Form 10 information might predate your Super 8K. You could you could sort of structure transactions to include an S4 or an F4, even though you're eligible to use a proxy, so that you have Form 10 information out there. The SEC's guidance on it, I don't think it's clear that you could just put all the information that's required in a Form 10 into a proxy statement, because the proxy rules are they have a slightly lower form restriction on some like technical stuff that doesn't really matter to anybody, but could you shoehorn it into the proxy and key off that date? You could, although a bunch of these restrictions do also require the shell company status to have gone away. So there's not many ways to really meaningfully improve your lie by over filing early. Okay. The other thing the SEC did, this was 2004 as part of securities reform, introduced a concept of ineligible issuers and said former shell companies can't be, or they are ineligible issuers until 3 full calendar years after ceasing to be a shell company. What this means is you can't use a free writing prospectus, which is sort of written materials that relate to an offering, but by virtue of SEC rules are not a prospectus. So you don't have the same liability on them, and you're allowed to use them in different ways. And you can't be a WIXI. You can't have an automatic shelf registration statement until 3 years after DSPAC. Now, your former SPACs are kind of in with a motley crew of other ineligible issuers. It includes companies that haven't filed all of their Ks and Qs timely for the past 12 months. It includes limited partnerships in certain circumstances, but then it also includes emerging from bankruptcy, companies convicted of felonies and misdemeanors, and companies that enter into cease and desist orders that they violated the anti-fraud provisions of the federal securities laws. So some pretty bad, bad things that the companies do to get put in ineligible issuer status. Some of them are just sort of companies that the SEC over time has said this kind of company is, quote unquote, has some problems. But former shell companies, interestingly, are actually treated worse than companies entering into cease and desist orders to not violate the securities laws in the future, in that the former shell companies are the only group in this that can't use a free writing prospectus that's limited to just the terms of the offering or a description of the offering itself. Everybody else can use sort of a offering only FWP. Former shell companies can't even do that. And then, so let me see anything else on here. Other minor things, the former shell companies are not eligible to update selling security information in the Form S3 via prospectus supplement. They can't incorporate a reference into Form S1 until 3 full calendar years after DSPAC. They're not eligible to use S8 until 60 days after filing of the Super 8K. And then the last one is they're not eligible for what's known as the baby shelf rules, which Sarah will talk about in a little bit, until 12 calendar months after ceasing to be a shell company. Now, this one's interesting because the SEC, after this rule was adopted, basically came out with a policy that said former shell companies can't use S3 until 12 full calendar months after ceasing to be a shell company, full stop. So any S3, not just the baby shelf, but any S3 is effectively not available for former shell companies for a year, full 12 calendar months. And it just highlights the SEC has some rules that sort of apply, and then they can adopt policies later that are effectively inconsistent with their rules or the requirements of the form. Okay, this I just included for completeness. There's a handful of safe harbors for certain communications not being prospectuses, like distribution by brokers and dealers of research, and the SEC, sort of consistent with its shell companies bad position, has basically prohibited shell companies from relying on certain of these safe harbors. Okay, so as newly public companies, former SPACs face pretty much all the same requirements that any company going public via an IPO would. So this is our, sort of now that you're public list of topics that we have for newly public companies. and these generally apply to SPACs, former SPACs, just like they would to any newly public company. Interestingly, if you look at 2022, more companies have gone public via de-SPAC than via regular way IPO. So where we would have said, okay, you're newly public, these are the rules we need to know about, and there'd probably be a little asterisk that says, oh, but if you were a former shell company, you have all these other things that you need to worry about. It's almost like the most common now that you're public presentation really should be, here's all the SPAC stuff that you need to know too. Okay, some quirks for former SPACs under the rules. So obviously there's the former shell company regs, which we talked about. SPACs also are faced with fund warrant accounting issues. Most companies that go public don't have the typical warrant, and 90% of the SPACs that went public over the last 2 years had warrants, and due to an SEC position as to how those warrants needed to be accounted for, have to treat them as liabilities and carry them as liabilities on their books, and update the valuation every quarter. The other thing that former SPACs will be dealing with that companies that go public via IPO won't really be is you'll need to have an S1 shelf effective to cover the warrant exercise or resale of the private placement warrants, the resale of the PIPE shares, the resale of the founder shares, and then potentially equity consideration. Depending on transaction structure, sometimes there's a big S1 shelf covering equity consideration. One caveat on that is you can't use S1 for a shelf for a company that constitutes the parent of the registrant. It's really only non-parents, and you can't use it on a primary basis. But having that S1 shelf out there and sort of dealing with keeping it current is a fun exercise that really only former shell companies really have to deal with most of the time. The other thing that's important to remember here is if you go public via an IPO, there's a whole slew of SEC regs and SEC statuses that key off of when you go public. Where you merge with a SPAC, and that SPAC went public, potentially 2+ years before the closing of the de-SPAC transaction, some of the obligations key off the SPAC IPO's date in certain instances. So your accelerated filer status, if you're public at least 12 months and have filed at least one annual report, you're an accelerated filer. EGC status keys off of when your IPO occurred, and your first sort of stay on pay vote needs to occur 3 years after the IPO. All those key off the SPAC's IPO date. I say it may key off the SPAC's IPO date because if you have a structure where there's a new registrant formed, like a double dummy, or the target acquires the SPAC, sometimes you get a different outcome on this. You wouldn't typically use that. You wouldn't force your way into one of those structures just in order to defer compliance with these, because usually there's tax consequences that drive you much more firmly one way or another in terms of structure. But
there's some nuances in determining whether you're succeeding to the reporting obligations in the history of the SPAC. And as Ramey said, it is critically important that you figure this out because it's going to be the driver of timing. Like if you were someone who's the SPAC originally IPO'd in 2020, then you have a say on pay vote this year. And in 2 years, you're facing a SOX auditor attestation requirement because your EGC status has ended. And usually, you need to start the work to be able to do that well ahead of that. So this is something that sometimes surprises people. They think that the starting date for calculating these obligations would be the closing of the de-SPAC, and it's not. For the most part, again, absent one of those structures that Ramey mentioned, where there's a double dummy structure or something with a new registrant, most of these, the start date is going to be the SPAC IPO date. So again, that's important to make sure that you understand here what is the basis of the beginning count for each of these for you. Next slide, please. Okay. All right. Fund prior guidance. Next slide, please. So, In the early years of de-SPACs, it actually was not that common to have a multi-year forecast. Usually 1 or fewer years was common then. In 2016, it crept up to 2 or more years. In 2020, we started to see the 4 to 5 year forecast. And then recently, particularly post the SEC proposed rule change, we've seen the forecast period creep down to more around like 2 or 3 years, or in some instances, no forecast at all. But for most of you that are on this, you probably have a 4 to 5 year forecast hanging out there somewhere, which is quite unusual, right? If you compare it to a typical IPO, while the IPO companies would give a 5 year forecast to analysts on analyst day that's never made public, it's just provided to the analysts, and then of course they put that in, they think about it in their research reports, but it's never publicly disclosed. So SPACs have sort of a unique problem in that they're living with this multi-year forecast. Next slide, please. Now, of course, if your lawyers are doing their jobs, there's going to be significant disclaimers everywhere that forecast was published. These are just a few examples of the 3 or 4 additional standard disclaimers. Basically, no one should rely on this, and we don't undertake any obligation to update this, which provides you some level of protection. Next slide, please. Oh, and there's the next polling question. Next slide, please.
Yeah, Sarah, on this one, just to sort of double down on what you said while the polling question's up, is a lot of times people will say, oh, projections aren't made in an IPO. And that's not quite right. They are made. They're just made in an analyst day to analysts, and then the analysts use them to build their analyst model. So the difference is they're just never publicly available to everyone, and they're not as sort of high profile, high visibility to investors, potential plaintiffs, attorneys, the SEC, et cetera. So it's sort of a quirk of going public via a merger transaction that you typically have some form of projections disclosed, and sort of then people focus on it more post de-SPAC than they do on what happened to the projections disclosed just to the analyst during the analyst day.
Yeah, and so as you start to look at that, and you're a public company post de-SPAC and living with that forecast that's out there, and of course you have the disclaimers on it, but those disclaimers may not be effective to protect you from liability if there are duties to correct material misunderstandings. And this is kind of a fuzzy area of law around the duty to correct. But really, it's as you think about it, and you think about the statements that you're making, they need to be not misleading in light of the circumstances under which they're made, which include your prior disclosures. Now, that's not to say that there's any obligation for you to continue to maintain or update a 4 or 5 year forecast. I don't think there are many people doing that, or many people that would advise doing that, given the difficulties in predicting out that far, as we're finding from de-SPAC companies. I think that the other ways to go about either walking yourself back from a forecast or just updating information to make sure that the market has current information. I think one of the simplest ways is for companies that are already cash flowing, already have operations. Once they come out of the gate, they will update, do a year of annual financial guidance and say, this is our guidance for the year. There's no guidance beyond that. And that kind of sort of, in a lot of times, that's, materially different from whatever the forecast guidance might have been anyway. And it kind of resets the guidance loop. But that might not be an appropriate approach for every company. It may just be that your business is too volatile for you to feel comfortable with doing any kind of annual guidance on an ongoing basis. Or you may be one of these companies that is pre-revenue for a period of time, so it doesn't really make sense to give next year's financial guidance. It's not going to yield anything useful, And for those people, I think there's a few things that you need to do, well, that everyone needs to be doing anyway. One is just providing operational guidance, right? If core to your original forecast was the assumption that, you were going to have X business line up and running by the middle of 2023, but it looks like now it's going to be 2024, or that you're not going to do that business line at all. Obviously, it's appropriate to update the market on that. Same thing with, if you had estimated that your cash flow to break even was a certain amount, and that amount is shifting, you may not reforecast that amount, but you need to find some way to indicate that marker has moved. And so a lot of this operational guidance or operational guidance regarding like when a facility may come online, when you expect customer contracts to start generating revenue, those things can be updated. And if hopefully in your forecast, you appropriately disclose the material assumptions. And now if you're disclosing things that say, okay, these material assumptions are different, right? Or that they've been updated, then, people can appropriately conclude that forecast is no longer applicable. So I think it's, as you think about this, and you probably will continue to get questions on it, which of course, you don't want to be commenting on a formal forecast. But you do need to think about, okay, what have we previously disclosed? You need to be very aware of what you previously disclosed with respect to your forecast and the assumptions, and then make sure that as you're moving along, although you don't need to necessarily update the forecast, you do need to make sure that if there's material changes to the assumptions, material changes to your circumstances, that you have disclosed that, and it's just a more acute circumstance when you're someone like a former SPAC that has a 4 to 5 year forecast hanging out there, and it's even more acute if you are offering securities on your own behalf, or if you have a resale shelf, which almost all former SPACs do. I don't know, Ramey, did you have anything to add?
Nope. You hit those.
Okay. All right. Next topic. Okay. So financing options. For a variety of reasons, we have found that many former SPACs are facing or may imminently face financing needs. Those that raised substantial capital from PIPE and Trust in 20 and 21 may need or expected to have incremental capital to achieve their operational goals, whether it's because they haven't hit the cash flow break even as quickly as they expected, or they were just assuming additional capital all along. And then those that de-SPACed in late 2021 or in 2022 and faced high redemptions likely didn't raise as much cash as they were expecting. And so there's a lot of people who are in need of interim capital injections. So we're just going to walk through a few options for that, and kind of the different things to consider as you go through each of those.
All right. So the sort of most common way to raise capital, the easiest, simplest sort of the mode for public companies is underwritten offerings. They have to be registered. You can either be registered on Form S-1, or once the company is eligible for Form S-3, on Form S-3. If you're on Form S-1, it's a discrete filing. You can't have a primary shelf on Form S-1. And so you file with the SEC, you go through the SEC review process. When you're done with that, then you can make an offer. One thing that's important to remember about underwritten offerings and former shell companies is the restriction on use of free writing prospectuses for 3 years post de-SPAC kind of puts underwritten offerings back in the sort of the retro world before 2005, when securities reform was adopted. Roadshows were conducted in person. You'd hand out a roadshow deck at the beginning of the meeting, and then you would actually collect them all back. Nobody could keep it because you didn't want it to be a prospectus. That's what you have to live with. So you can't use free writing prospectuses, and that includes sort of net roadshow presentations. Now, the SEC guidance, when they adopted free writing prospectus regs, basically says you can have a net roadshow, you can have a presentation, a sort of written, quote unquote. I'm going to say it's written, but graphical is what they mean. You can have a slide deck that you present as part of a roadshow, but it has to originate live with the roadshow itself. So you can't record it and let people go and watch it online. It has to effectively be live, which means it's going to be more sort of demanding for management because they're actually going to have to participate live in roadshow presentations, whereas other newly public companies record it, post it to Net Roadshow, and then people could review it, at their leisure. So the underwritten offering will involve a multi-day book build, particularly for the first offering. So it's going to be demanding on management time. The underwriters will expect a company and insider lockup of usually 90 days. All in, you're probably looking at a high single to low double digit all-in discount. So it's fairly costly, but it can allow you to raise a substantial amount of capital, and it can improve your public float and liquidity, with liquidity being kind of important for some former SPACs, but particularly where they have high redemptions. They may have a really small amount of public shareholders trading. The way these things have to be announced before they're priced means that the public announcement of this type of deal can have an impact on the stock price, and you can't sort of pull it back. You don't know you're going to be able to do this deal until to pricing at the end of the roadshow.
Yeah.
Next slide.
Yeah, and one thing I'll talk about before I talk about ATMs that's applicable both to Ramey's slide on underwritten offerings and to the ATM is just getting, to the extent that you're S3 eligible, getting a universal shelf up to give you flexibility to do this. And I say this because a lot of former SPACs have a significant amount of shares held by affiliates and very, very limited what we call public float, the shares, that are held by non-affiliates. And the SEC has a rule that says that if you do not have more than 75 million of public float, then you are in what they call baby shelf land. And that means that you are limited to selling shares equal to 1/3 of the public float in any 12-month period, which is obviously very limiting on what you can do in terms of an underwritten offering or in terms of an at-the-market equity offering. And so I think, for people that are in that cuspy region, like just over 75 million, it may be worthwhile for you to put a universal shelf up to preserve, even if you don't currently intend to do an underwritten equity offering or an at-the-market offering, to preserve the ability to do one of those offerings without having being subject to the baby shelf rules. Because once you get that up, even if you fall below that 75 million public float threshold, you would still be able to use that shelf until the next 10K reevaluation date. And so if you're thinking and you're planning ahead, that's one reason why you might want to put it up. The other is that an S3 is subject to SEC review. A lot of times they no review it, but it takes them 10 days to tell you that. Or if they review it and have limited comments, that's another 2 weeks. So it's not something that you can necessarily do automatically. So a lot of people are exploring the flexibility of having a universal shelf ready, even if they have no current intent to do an underwritten offering or an at-the-market equity offering. So that's just sort of thinking about making sure you have that flexibility to the extent you're S3 eligible. And then we do see a lot of former de-SPACs doing ATM or at-the-market equity offerings, which is essentially, issuers conducting sales through an agent on an ongoing basis off of a shelf registration statement. You must be S3 eligible to do this. You can only, you're going to have to wait at least a year after you've de-SPACed in order to be able to do this. Their primary sales through brokers. And typically what happens is you enter into a EDA with your agent bank. There's diligence around entering into that EDA initially. And then there's going to be quarterly diligence with the banks just to bring down on every quarterly report. But that's, it's not a terribly exhaustive process. And then the fees paid to the agent are typically much lower than the fees paid to the banks in an underwritten offering, and you can sell from time to time in periods where you're not in possession of MMPI, which generally lines up with your open trading windows. So a lot of people like the flexibility of sort of the interim capital raise. The downside is it is hard to raise substantial proceeds quickly, especially if you're a stock, like many former D-SPACs, that's very thinly traded. But if you're looking for a little bit of extra liquidity, a little extra cushion, many people find that this is a nice way to achieve it, or like to have these programs ready, just even to have the optionality there. So we've seen a lot of former D-SPACs do ATM programs.
So one thing we're seeing that's getting a little bit of traction with former SPACs is an equity line. Sometimes they call it an ELOC, equity line of credit. It's kind of odd to me because it doesn't seem like credit when you're issuing equity, but I wasn't consulted on the name. So what this is a private placement from time to time of stock to a financial institution. So you sign up an agreement. At the beginning of one of these programs, the financial institution says, I will buy shares at an X discount, usually based on the VWAP after the company provides notice that it's going to be issuing shares to the financial institution. There'll be a discount to that. And then the company puts up a resale shelf to cover the resale by that institution of the shares that it buys. So very similar to an ATM, except instead of the institution just acting as a broker to pair primary issuances with demand on the market, here it's a private placement to the institution, and the institution in turn resells. Only thing to note on this, one thing is obviously if you can use an S1 for it and you're not S3 eligible, this is effectively your only option that's similar to an ATM, but it will have a larger ATM fee, and it usually has an upfront commitment fee paid either in cash or stock or warrants or some of all of the above. So it can be pretty expensive.
Okay, and then many former SPACs are continuing to do private placements or PIPEs to institutional investors. A lot of times this will be a PIPE that's funded by existing investors, or it'll be a PIPE that's funded by a strategic investor, maybe a customer, or sometimes, a large private equity player will come in and fund a PIPE. These are marketed and executed under a non-disclosure agreement. So there's not going to be a public market impact until after execution. And typically it's arranged where you say, if we don't move forward with this, we don't have any disclosure. Most of these, there's a lot of focus on liquidity. So you're going to have to file a resale shelf, almost immediately after closing. And then, because if there's limited public float already, it doesn't necessarily mean that there's going to be an increase in that public float in the near term, just because of the limitations on being able to dribble out in the market that quickly. But you can expect probably over time that some of those PIPE shares will find their way to the public market and increase liquidity and public float.
And so where a common equity PIPE is not available for one reason or another, you might also see preferred equity or convertible debt. And you're seeing this a fair amount. Sometimes people call these structured PIPEs, which is kind of a misnomer. It's a convertible preferred or convertible debt or mandatorily redeemable preferred. So it's kind of hard to summarize what these things typically look like, because there's a whole panoply of different sort of customized terms that you can negotiate on a one-off basis based on the needs of the company or the needs of the investor. The flexibility is really the only sort of bookends on it is if you have a convertible preferred or exchangeable debt, you need to have sufficient available capital under your charter, or you're going to have to go out and seek a proxy vote in order to increase it, or you need to make sure that you have blank check preferred, which most former SPACs do under their charter. And then exchange listing rules may require a shareholder vote where you're issuing more than 20% of the outstanding shares or the outstanding vote. So a lot of flexibility here, but given that it's sort of a blank sheet of paper effectively that you can start with, it can result in a pretty protracted negotiation to negotiate all the terms. As compared to the discount that you might have on a PIPE, you may have less dilution of the common equity by virtue of the fact that you've got downside protection in the forms of either a preference or that it's debt. And then if your goal here is to increase liquidity of your common equity, this isn't really going to help until you get to the point of conversion or you refinance it with common equity.
Yeah. And finally, to the extent that none of these are available to you, and you're kind of staring down the barrel of a potential going concern, or other limitations on growth because you can't access capital. We obviously have seen some SPACs look at merging with either another former SPAC or merging with another company that has a stronger balance sheet to execute their growth story. And so those are obviously options too.
Yeah, and one other thing, financing option, although it's not practically for 99.9% of the former SPACs today, is forced exercise of the warrants is another way to raise capital. We'll talk about that in just a second here. Next slide. Okay, so as I said, 90% of SPACs that went public over the last 2 years had a pretty standard suite of warrants. And those warrants have a 5-year term post-SPAC. So former SPACs may want to clean up their capital structure, eliminate the warrants, either just to get them, sort of off of its capital structure and the liability if they're liability accounted. But you can also use it to raise capital. If you can force holders to exercise for cash, you can effectively raise capital at $11.50 per warrant. There's a couple ways to do this. Most SPACs have some call or redemption feature. I'll talk about the two most common in a minute. Or you can try and induce people to exercise by lowering exercise price or doing a tender or exchange offer. The standard redemption features, they're styled as a redemption right of the company, but they're really forced exercise. Unless the stock does something really crazy after announcing one of these redemptions. So the standard redemption that just about every SPAC has is if the stock is trading above $18 for a meaningful period, the company can call the warrants for a penny per warrant. So the idea is the company provides notice of this call, and then all of the warrant holders who have a brain should exercise because they pay $11.50 for something that's worth at least $18. Now, there is some, like I said, there can be some really funky trading that means you can announce the exercise of this, then the stock price falls below $11.50, and then warrant holders shouldn't exercise. But that's not what this is intended to do. Some SPACs, not all of them, also have what's known as a make-whole redemption, where if the stock is trading above $10, the company can redeem the warrants for 10 cents. But it has to give people either the ability to exercise for cash or the option to exercise on a cashless basis based on a grid that's specified at IPO. So give me your warrant, I will give you a third of a share, just hypothetically. Both require a 30-day notice of exercise, so the company provides notice. People have 30 days to either exercise the warrants or figure out what they're going to do, or they'll get the penny or the 10 cents. The warrants have to be exercisable. It starts 30 days post-SPAC, and you have to have an effective shelf. And then there's a lot of different variation in the terms of these. You got to really focus on it. There's a couple of them out there where holders can only get stock based on the make-whole redemption. There's no exercise feature. And it's important to remember that the private placement warrants that are issued to the founders at IPO typically are not callable. So if your goal here is to clean things up, you're going to have to negotiate with the holder of the private placement warrants in most former SPACs. As I mentioned before, you can attempt to induce people to exercise by reducing the exercise price. You can say temporarily, we'll let you exercise for $10 instead of $11.50, something like that. Or if you're just hoping to clean up your books, you can tender for them with cash, stock, or a combination. You can get creative here and conditioned on minimum participation. You can do something like a covenant strip and amend the terms, assuming you meet the amendment requirements. Now, you will be subject to the tender offer rules, filing with a Schedule TO, 20 business day term, because these things, typically the warrants are listed on a national securities exchange. And then if you just want to say, I will trade a warrant for a share of stock, you may not have to register that if you have no solicitation agent. If you're issuing stock, you'll be in S4 land to register this type of transaction, in addition to the TO. The last topic, we can go over pretty quick, is liquidity options for existing shareholders and delegending requests. This is one of the more annoying things for SPACs to deal with, frankly, just because you've got a whole bunch of PIPE investors, a whole bunch of holders of equity consideration. They want to move those shares out to brokerage accounts. They want to sell them. The shares are all going to be restricted. Next slide, please. For the most part, they'll be restricted. And the transfer agent will insist on a legal opinion in order to move shares off of its books. So you'll have a whole bunch of different shareholders with restricted securities, the SPAC sponsor, the PIPE investors, and the recipients of equity consideration, except for non-affiliates who received shares registered on an S4 or F4. All of them will get shares that are legended on the transfer agent's books, and in order to move them, you have to get a legal opinion. So moving the legend off of restricted securities, as I said, requires a legal opinion. Rule 144 is the sort of cleanest way for companies that go public via IPO to pull these. After a year of holding the shares, they will not have to be subject to continued public information for non-affiliates. So basically, law firms can say, have these shares been outstanding for a year? Yes, no. Is it a public company? Is it current to that point? I can just opine that you can remove the legends because the non-affiliate can rely on 144. The rule applicable to SPAC says you have to have current public information regardless of whether it's affiliated or not indefinitely, means you can't opine just on the availability of 144. So different law firms will require different things. Some will only pull legends in connection with an actual sale, either a registered sale or a sale under 144. Some will pull legends on the basis of what's known as will comply certificates. So that's a promise from the holder and the broker that they'll comply with either the registration requirements or 144 restrictions. And then some brokers can't, they're not set up with internal procedures in order to police the promise that shares will only be sold in accordance with the registration or Rule 144, and so won't deliver these. So you'll end up with this sort of patchwork of who you can pull legends for, who you can't, and it can be pretty demanding sort of just from an investor relations standpoint to sort of basically figure out, okay, can we pull these legends, can we not? And so I think that's, I don't know, Sarah, do you have anything you want to add on that?
I think on that, it is important to understand kind of the rules of the road with your law firm and what your law firm is willing to do. And, you know, in certain circumstances where your law firm may not be willing to do it, but it's something that the PIPE shareholders law firm may be willing to do, there may be an opportunity for, you know, if you're comfortable with that, with them issuing the opinion. So there's things to be explored there, but this is the bane of the existence of de-SPACed companies, and unfortunately, unlike IPO companies, it doesn't go away after a year because for de-SPACed companies, Rule 144 always has that current information requirement. But we found when we're dealing with our de-SPACed companies, again, having forms preset, here's what you need to do, having some FAQ for them so they can answer questions on, you know, on what you would need to do in order to delegend and move to a brokerage account. That just being very well informed ahead of time, because again, when people are looking to move these, they're typically looking to move them quickly. And then, you know, and then hopefully over time, the burden of this becomes less as people have moved from restricted shares into the public market.
So one question that was posed was whether there are Reg FD, fair disclosure requirements, issues applicable to providing objections to analysts during analyst days. And the answer is generally yes, but there's a sort of one-time get out of jail free card in connection with the IPO, which is Reg FD doesn't apply until you have a registered class of securities under the 34 Act. That happens basically the day of or the day before pricing of an IPO. So the IPO analyst day happens before you're subject to Reg FD. So if you go public via IPO, you can have effectively a confidential analyst day, and you never have to make that information public. By contrast, when a de-SPAC is happening, the SPAC is subject to FD already, and so you couldn't have an analyst day like you could for an IPO.
Okay, and then I think the other question is there a way to accelerate the expiration of the fund? Special SEC rules that are applicable to former SPACs. I mean, generally the answer is no. As Ramey said, you need to explore whether your starting time is the filing of your Form 10, or if you had an S4, if your law firm is comfortable that you could say that that's the start date of that. But I think that's really the only opportunity to kind of move it up, and then otherwise, for the vast majority of them, you're just waiting for years. Okay, if there are any other questions, submit them, or you can always feel free to reach out to me or Ramey. Happy to help, and hope that all of you join us for the proxy season CLE in a couple of days as well. Thank you.